You're lying in bed, lights off, phone glowing in your face. You open your banking app, mostly out of habit, maybe a little curiosity, and then you see it, $20,041. You blink. You refresh the app. Still there, $20,000. For a second, you just stare at it, because you remember when your balance used to be $214 and you were calculating whether groceries would balance your rent payment. You remember checking your account before buying coffee. You remember that one month where your emergency fund was literally a jar of coins and optimism. But now somehow, after months or years of grinding, skipping things, working extra hours, saying maybe next time more times than you can count, you made it. 20,000. It feels like crossing a finish line. You feel responsible, disciplined, like you've cracked the code. And then something strange starts happening. Suddenly your phone starts showing ads for investment apps. Your bank sends you emails about exclusive opportunities. Your brain starts whispering things like, maybe I deserve a better car. Maybe I should upgrade my apartment. Maybe I should invest in something exciting. Because after all, you've been responsible. You earned it. And this is the catch. The moment you finally become financially stable, the world starts trying to sell you instability. Because the system isn't really designed for people who quietly build wealth. It's designed for people who almost build wealth. People who get close, celebrate, and then slowly slide backwards. And that's why your first $20,000 is the hardest money you will ever save. But it's also the most important, because for most people, this is the exact moment they lose it. Most people think saving money is like running a race. You start at zero. You struggle. You sacrifice. You grind forward until you cross the line. But money doesn't work like a finish line. It works like a foundation. And foundations are weird, because nobody celebrates pouring concrete. They celebrate the house that comes later. But the foundation cracks, the house collapses. Your first $20,000 is a foundation, and almost nobody protects it properly. According to surveys from the Federal Reserve, nearly 37% of Americans can't cover a $400 emergency without borrowing or selling something, which means simply having savings already puts you ahead of a huge portion of the population. But here's the uncomfortable part. Even people who reach this milestone often lose it. Not because they're irresponsible, not because they're stupid, because the system quietly nudges them to. When you have nothing, the system ignores you. When you start saving, suddenly everyone wants access. Banks want you borrowing. Apps want you trading. Friends want you celebrating. Your brain wants relief. And that's not a personal failure. That's almost everyone. The moment people finally feel stable, they relax the exact habits that created the stability. Like someone who finishes a diet and immediately celebrates with pizza, except instead of gaining 5 pounds, you lose 5 years of progress. My name is Peter. I'm obsessed with how money actually works. Not the motivational poster version. Not the buy my course version. The real version. The weird psychological version. The version where small habits quietly shape your entire financial life. Quick disclaimer before we go further. This is education and entertainment, not financial advice. I'm not your advisor. I'm just a guy who spends way too much time thinking about money systems and why normal people struggle with them. If you need financial advice, talk to a professional who knows your situation. Now, let's talk about what actually changes when you hit your first $20,000. Phase 1 is the grind phase. This is the hardest psychological phase of money because everything feels fragile. You're building savings while your brain is constantly whispering, what if something goes wrong? What if I lose my job? What if the car breaks? So you save carefully, slowly, almost nervously. And that fear actually helps you. It keeps you disciplined. But then something strange happens when you reach that first real cushion. Your brain relaxes. You start feeling safe. And when humans feel safe, they start expanding their lives. Better furniture, better trips, better tech. Nothing crazy, just upgrades. And the system is incredibly good at encouraging this. Because once you have money, you become a very attractive customer. Credit card limits increase. Investment platforms start sending opportunities. Banks start offering loans you never asked for. Suddenly, you're not just someone trying to survive. You're someone who might buy something. And here's the psychological trap. After scarcity, rewards feel justified. Your brain starts running a quiet story. I've been responsible for so long. I deserve to enjoy some of this. And sometimes that's true, but the danger is subtle. Because the moment your lifestyle grows to match your savings stop growing. You hit financial equilibrium again, just at a higher level, which means instead of escaping the cycle, you've simply upgraded the hamster wheel. The system actually loves this outcome because stable savers eventually become predictable consumers, and predictable consumers are profitable. Let's talk about the math for a second, because the math behind this milestone is surprisingly powerful. If someone invests $20,000 and earns an average of 7% annually, in 10 years it becomes roughly $39,000. In 20 years, about $77,000. In 30 years, around $152,000. And that's without adding another dollar. Now imagine adding just $300 per month on top of that. Suddenly the timeline looks very different. After 30 years, that could grow to over $500,000, depending on returns. That's the quiet power of the first pile of money. It's the seed. But here's the uncomfortable statistic. Studies from Vanguard and Dalbar show the average investor underperforms the market by several percentage points every year. Not because markets are bad, because people interfere. They panic. They chase trends. They celebrate milestones by loosening discipline. In other words, the biggest risk to your first $20,000 isn't the economy. It's human nature. Let me tell you two quick stories, both fictional, but painfully realistic. Alex hits $20,000 after 3 years of careful saving. At first, Alex is proud. Then the upgrades begin. A slightly nicer car, a new phone, a vacation that feels deserved. None of it seems extreme, but slowly the buffer shrinks. $20,000 becomes $17,000, then $13,000. Then an emergency happens. 6 months later, Alex is back under $5,000, wondering what happened. Now Jordan. Jordan also reaches $20,000. Same excitement, same temptation, same system pushing offers. But Jordan creates 2 simple rules. Rule 1, the first $20,000 is the floor. Not spending money, not opportunity money. Emergency stability, untouchable unless life truly explodes. Rule 2, all new money goes into a separate growth system. Investments, retirement accounts, slow, boring assets. Jordan still enjoys life, still travels, still upgrades things occasionally. But the foundation never disappears. 10 years later, the difference is dramatic. Alex is still rebuilding savings. Jordan has options, because the gap between people financially isn't usually intelligence. It's small structural decisions repeated for years. And protecting the first pile of money is one of the biggest. So if you're approaching this milestone or you just hit it, here's a simple playbook. Nothing fancy, just structure. Number 1, set the floor. Your first $20,000 isn't wealth. It's stability. Treat it like the concrete foundation of your life. It stays there, quietly protecting you. Number 2, build the growth layer. Anything above the floor should start working. Index funds, retirement accounts, long-term investments. Not exciting, but boring compounds. And boring compounds win. Number 3, create an options layer. This is where lifestyle improvements live. Trips, upgrades, experiences. The key is separating them from the foundation, because when everything mixes together, everything slowly disappears. Number 4, be suspicious of sales. When you start becoming financially stable, everyone wants to help you optimize. Fancy investments, new financial tools, exclusive opportunities. Some are useful. Many are just expensive distractions. Remember something important. The financial industry makes far more money when you move your money than when you quietly keep it growing. Movement is profitable, patience is powerful, and patience is rarely advertised. So if you remember one idea from this entire video, let it be this. Your first $20,000 is not the finish line. It's the floor. It's the moment where survival slowly turns into possibility. The moment where emergencies stop destroying your life. The moment where time starts working for you instead of against you. And the real catch? The system quietly hopes you celebrate that moment by dismantling the foundation that created it. So protect it, guard it, respect it, because the people who quietly win with money usually do one boring thing incredibly well. They protect the first pile like it's sacred. Not because $20,000 makes them rich, because it makes them stable. And stability is where real wealth actually begins.